Yes, good evening and welcome to class. Hope you are very fine this evening. So confirm whether we are together, then we can start. You can just say good evening. You can just say good evening. I can see ARG says good evening. ARG says good evening. What about the rest? I can see a number of you having to say good evening. So in this case, we can actually continue from where we left in our previous class. We were looking at, in this case, special transactions and how you could end up having to treat them when you're having to do consolidation or conduct, in this case, what consolidation, or come up with a consolidated financial statements. I think we had actually gone up to number 6. That was, I think, in this case, goodwill. It was up to number 6. Was it number 6 or number 5? Number 5, I think we had gone up to number 5. Number 5, we in this case looked at goodwill. We in this case looked at goodwill. So we are just remaining with 3 of them. Then in this case, I think we can be able to look at a comprehensive illustration from the past papers. So in this case, you can be able to write number 6. Number 6, fair value adjustments. Fair value adjustments. Fair value adjustments. So number 6, you can be able to write fair value adjustments. Fair value adjustments. Fair value adjustments. So when you talk about fair value adjustments, sometimes in this case, you might be told that the subsidiary ended up having to revalue its assets, maybe on acquisition or maybe during the post-acquisition period. So how do you actually end up having to treat this? So you can be able to write fair value adjustments. So IFRS number 3 requires, IFRS number 3 requires identifiable, requires identifiable. IFRS number 3 requires identifiable assets and liabilities. Identifiable assets. Identifiable assets and liabilities. Identifiable assets and liabilities of the acquiree. Of the acquiree or subsidiary. Of the acquiree or subsidiary. IFRS number 3 requires identifiable assets and liabilities of the acquiree or subsidiary to be measured initially by the acquirer holding company, by the acquirer holding or parent company, by the acquirer or holding or parent company, at their fair value, on the date of acquisition, on the date of acquisition. So that in this case, when the parent company is having to acquire the asset, or in this case, the subsidiary, at that particular point in time, they're having to acquire this subsidiary. They must have been able to value those assets at the fair value, at the prevailing market value of these assets. So considering in this case, the prevailing market conditions, what is the value of these assets? That is the value at which in this case, they're supposed to do what? To be valued. They are supposed to be valued. So in this case, they can be able to make what are relevant fair value adjustments and ensure the assets are having to be acquired in this case at what? At their fair value. At their fair value. So you can be able to write when the subsidiaries assets are revalued, 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 on acquisition, when the subsidiaries assets are revalued on acquisition, when the subsidiaries assets are revalued on acquisition, comma, the subsidiary, comma, the subsidiary the subsidiary may not have incorporated the revaluation in its own books, may not have incorporated the revaluation in its own books. So in this case, you revalue them on the date of acquisition. The subsidiary might not in this case have considered that revaluation in their books. So because in this case, you're having to say, for example, if you acquire on 1st of January 2025. So the assets, in this case, all of them will be, like in this case, you'll value them at the prevailing fair value, or the market conditions that are having to prevail will determine the value of those assets having to be acquired by the parent company. But now, the subsidiary might not have actually recognized these revaluations. You're having to talk about on the date of what? Of acquisition, on the date of acquisition. So in this case, if this is the case, then you write in this case, you write in this case, the revaluation needs to be adjusted before consolidating the subsidiary. In this case, the revaluation needs to be adjusted before, in this case, the revaluation needs to be adjusted before consolidating. Needs to be adjusted before consolidating the subsidiary. Need to be adjusted before consolidating the subsidiary. But you have to consider that revaluation. So in this case, the assets in the books of maybe the subsidiary were maybe 10 million. Then you are told on the date of acquisition, the assets were measured at a fair value of 12 million. So the extra 2 million in this case has to be considered before you end up having to do what? Do the consolidation. Or in this case, when you're having to consolidate, you have to consider that. So what will happen in this case, it means there will be an increase of like 2 million on the value of the assets. So in this case, you can be able to write the final point. What happens now in this case regarding depreciation on the extra amount? What happens regarding depreciation on the extra amount? So depreciation adjustments may also be required for assets which are to be depreciated. So the depreciation adjustment may also be required. Depreciation adjustments may also be required. For assets, which are to be depreciated. For assets which are in this case to be depreciated. So in this case, you consider the depreciation, in this case, what the revaluation. So in this case, also you account for it. So in this, if you look at in this case, what you are looking at, what in this case you are looking at when you are calculating goodwill. There's somewhere in this case you're having to say you consider what you call pre-acquisition, in this case what? Reserves. So sometimes in this case you'll be told when the assets were being acquired, when the company was having to acquire, they revalued in this case what? The assets from maybe in this case 10 million, in this case what? 12 million. So this creates a revaluation reserve of 2 million. So what you're having to put there as the pre-acquisition reserves, sometimes you normally consider this figure. If you are told the values of the subsidiary company were revalued up to this amount, so it means that revaluation in this case would have actually been created, and therefore when you're calculating goodwill, this is what you're having to say you have to consider it. When you're calculating goodwill, you'll end up having to consider that what? Revaluation. And of course, you'll be able to see it in some of the questions. Once you look at a question, you'll be able to see it. So that's in this case, you treat what? Any fair value adjustments on the assets. So it's a requirement. The parent company does what? The revaluation, or revalues, in this case, the assets to fair value. If that happens, it means that the revaluation reserve that will be created, which in this case is normally considered as a pre-acquisition revaluation reserve, which in this case you can be able to consider when you are calculating the goodwill, because this now will likely end up having to be part of the net assets of the subsidiary on the date of acquisition, and therefore you'll consider it when you're calculating the goodwill. So we can look at now in this case so we have in this case what is remaining: computation of NCI and computation of, in this case, what retained earnings, computation of retained earnings and NCI. So maybe before we look at that, I want us to look at an illustration. We can look at an illustration. Then in this case, I'll be able to show you later how in this case you can actually be able to compute the NCI and the retained earnings. So let's look at an illustration first of all. And see how the examiner will end up having to test some of these questions. So you can be opening December 2024, question number, it is December 2024, question number, is it question number 2 or something? December 2024, question number 2B. So hope you can be able to see that question. December 2024, question number 2B. December 2024, question number 2B. So open that particular question. December 2024, question number 2B. December 2024, question number 2B. So are you there? Once you're there, you tell me you are there. So once you're there, you tell me you are there. December 2024, question number 2B. What you've just looked at is a continuation of what we had done in the previous class. The point you've looked at, it is point number 6. Key adjustment number 6, fair value adjustments. So we just continue from where we left in our previous class. If you are not in our previous class, it means then you are lost a bit. So you need to be on track by adding towards the previous class video. So if you're there, you tell me you are there. So I can see you are saying yes, you are there. But before, in this case, we do that question, so you can be able to write this NB. You can be able to write this NB. Before we look at that particular question, write this NB and say, if the subsidiary was acquired in between two financial reporting dates, if the subsidiary, NB number 1, if the subsidiary was acquired, in between two financial reporting dates, if the subsidiary was acquired in between two financial reporting dates, comma, the items in the consolidated statement of income, 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 will be apportioned appropriately, the items in the income statements will be apportioned appropriately according to the time period, the subsidiary, according to the time period, the subsidiary existed as a member of the group. The subsidiary existed as a member of the group, existed as a member of, in this case, what, the group. So in this case, if a subsidiary was acquired in between the year, so in this case, you'll likely be given two income statements. You'll be given the income statement of the parent, the income statement of, in this case, what? The subsidiary. So in this case, you'll be told sales is actually maybe 60. This one is actually maybe 30. You'll be told cost of sales. This one is maybe 90. This one is actually not 90, but you can be able to say maybe 40. This one is actually what? 15. Then you are told the subsidiary S was acquired on 1st of June, 2025. The subsidiary in this case S was acquired on 1st of June, 2025. And in this case, the financial statements you are preparing are as per 31st of December, 2025. So this means this subsidiary existed as a member of the group for how many months? It was acquired here. It means it existed as a member of the group for how many months? It means it existed as a member of the group for how many months? Yes, I can see you are saying 6. So that's where the problem is. That's where the problem is. So you need to be very careful with the dates. It is 7 months. You need to be very careful. Now, that is one of the tricks in the exam that will be there. When you see a date, when it was acquired, be very keen about that. You will say 6 months and it is 7. It is 7, it is 7, it is 7, it is 7. It is 7. You see the trick? You need to be very keen about the date of acquisition. You will say 6. Then you apportion the items using 6 months. It is supposed to be 7 months. You have to be very keen about the date of what? Acquisition. That's one of the tricks the examiner uses. So you'll be using 6 to apportion. Yet it's supposed to be what? 7 is supposed to be 7. This means in this case, when you are consolidating, this is what you'll be doing. You'll be saying for sales, you'll be saying in this case 60 plus 7 out of 12 times 30. Then now we consider any other adjustments. For example, intercompany sales, we were there during the post-acquisition period, we'll consider. When you go to the cost of sales, we'll likely be saying in this case 40 plus 7 out of 12 times 15, because the subsidiary existed for how many months? 6. This is what this statement means. You apportion appropriately according to the time period the subsidiary existed as a member of the group. It existed as a member of the group for 7 months. So when you're consolidating, you apportion these items in the income statements according to the time period it existed. So that's very important. You take note of that. Don't forget, in this case, you don't apportion, then things will go marambas for you. Imagine you will end up having to score a 0 in the statement of consolidated income. Just imagine. So number two, just be keen in this case about number 2. What about number 2? In this case, the items in the statement of financial position, will be added line by line. The items in the statement of financial position, will be added line by line. Without apportionment. Without apportionment. According to the time period. Without apportionment, according to the time period. According to the time period, will be added line by line. You can underline line by line without apportionment. You can underline line by line without what? Apportionment. Here, you can be able to underline will be apportioned appropriately. Will be apportioned appropriately according to the time period. And what are we talking about? The items in the consolidated statement of income. The items in the consolidated statement of income. While in this case, you're talking about what? The items in the statement of financial position. It doesn't matter. Even if in this case, it was acquired on 1st of June 2025. Don't apportion. Don't apportion. That is another trick. So if you go to this one and you start apportioning, things will go marambas. You might score a 0, just imagine a 0, and there's no way in this case you can score 0 in consolidated statements. You can't score 0, so you just have to be keen about the simple things. The date of acquisition. Then in this case, you have to remember for the items in the income statement, you do apportion. The items in the statement of financial position, don't apportion. Don't apportion. Add them line by line. And if in this case they have any other adjustments, you can make them. So in this case, if you are told it was acquired on 1st of June, the subsidiary was acquired 1st of June. If in this case you are told PPE, you just add them line by line. You pick for the parent, you add that one for the subsidiary. Don't put times 7 out of 12 in the statement of financial position. Don't apportion. Don't apportion. Add them line by line and then make any other necessary adjustments. But don't apportion like what? In the income statement. That is very important. You need to take note of that. You need to take note of that. Now we can be able to look at this illustration. December 2024, question number 2B. So hope you are there. December 2024, question number 2B. December 2024, question number 2B. So December question number 2B. Yeah, so the question reads, on 1st of November 2023, KIP Limited acquired 75% of the interest in Lima equity shares. The acquisition was completed through a share-for-share transaction, where KIP Limited exchanged 2 of its own shares for every 3 of Lima's limited shares acquired. On the date of acquisition, KIP Limited share price was having to go for 40 shillings. You are given some summarized income statement there. You are told the summarized below are the statements of profits or loss and the other comprehensive income for KIP Limited and Lima Limited for the financial year ended 30th of April 2024. In this case, you are told we have revenue, we have cost of sales, GP, distribution costs, admin expenses, finance costs for the 2 companies, the parent and the subsidiary. So income tax expense, you are given, profit for the year, you are given. So in this case, the other comprehensive income, in this case, you are also given there. The loss on fair value of equity financial assets is like that. So in this case, you have to take note. KIP is actually what? The parent. KIP ni mzazi. KIP ni mzazi. KIP is the parent. Is the holding company. It acquired who? Lima. And in this case, Lima, is it an associate, a subsidiary, or in this case, is it a simple investment? It is what? It is a subsidiary because now in this case, you can see you're having to be told it was a 75% interest. It was a 75% interest. It was a 75% interest. That was in this case not acquired. It is a subsidiary. And then in this case, you're given some additional information. You are told details of equity as of 1st of November 2023 on the date of acquisition, because it was acquired on that date. These were the items of what? Of equity of the 2 companies. These are basically the net assets. These are basically the net assets of the 2 companies. The equity part. The equity part. The net, you remember in this case, we talked about net assets. The equity part is usually very important, especially in this case, when you want to calculate what? Goodwill. When you want to calculate goodwill, you must be able to know what is under the net assets. That's why you're having to be given it here. You are told the ordinary shares was in this case for KIP this and Lima this. Share premium was this for KIP, and the other one didn't have share premium. Revolutionary reserve was there actually. It was in this case 33,600. The equity reserve was in this case of 12,800 and 8,800. Retained earnings on the date of acquisition were 360,000 and 500,000 for both companies. The note number 2, you are told that KIP Limited follows a policy of revaluing land to market value at the end of each reporting period. That's what the parent company does. Then Lima Limited had previously measured its land at historical cost before being acquired. Since the acquisition, Lima Limited land increased by 4 million in value, which it has recorded in its financial statements. You see that 4 million if you look at in this case, look at the income statement of Lima. You can see there a figure of 4 million. You can see under other comprehensive income. You can see under other comprehensive income. You can see a figure of 4 million. Is what they are talking about in note number 2. And is what they are talking about in this case. Those are basically post-acquisition revaluations. They are post-acquisition revaluations, which in this case have actually been considered in having to come up with the income statement. It means in this case, we are supposed to, in this case, just add them. We'll be able to add them because they are already, in this case, in the books of accounts. When you are consolidating, we'll say 10 plus 4. So like that, we'll add them. They are supposed to be added as part of, in this case, what the profit, the retained earnings, the total comprehensive income for the group. That's what they are supposed to do with them there. Then number 3, after acquisition on 1st of November, KEEP Limited transferred a plant equipment to Lima Limited at an agreed value of what? 20 million. So that's what we call what? An intercompany sale of what? Of a fixed asset. This equipment had a carrying amount of, in this case, what? 16 million at a transfer debt and remaining useful life of, in this case, what? 2.5 years. KEEP Limited accounted for the gain from this transaction by reducing its remaining useful life, reducing its depreciation expenses. Depreciation is charged to cost of what? To cost of sales. It's charged to cost of sales. We said in this case, if there's an intercompany sale of a fixed asset, if there's an intercompany sale of a fixed asset, there are 2 major computations we do. Which ones? When you see there's an intercompany sale of a fixed asset, there are 2 major computations you have to do. Which ones? You don't have to start thinking. You just need to open back your notes and check. What did we say we calculate? We calculate what? The unrealized profits on, in this case, what? The sale of the fixed asset, and what else? What else do we calculate? Apart from the unrealized profits? You calculate what? Depreciation. So in this case, you have what? The profit on the sale of the fixed asset, profit on sale of the fixed asset, which you have to, in this case, do what? Eliminate. You have to calculate it. Then also, in this case, you have to calculate, in this case, what? Depreciation. Now you must actually start having to mark which kind of calculations are you supposed to be able to do. When you just see an intercompany sale of a fixed asset, I must think about how will I calculate, in this case, what? The depreciation on that what? Sale of fixed assets. The depreciation overcharge is what we call overcharge. Depreciation overcharge. Then in this case also you have to calculate, in this case, what? The profit on the sale of the fixed asset. So of course you haven't been given. It means in this case you have to calculate it. You have to calculate, and now in this case do what? You'll end up having to eliminate it. You'll have to, in this case, do what? Eliminate it. You eliminate it by having to debit the cost of sales, and in this case you credit what? The property, plant, and equipment. So for the overcharge, you'll likely end up having to debit, in this case, what? The PPE, and in this case you credit what? The cost of sales, or in this case what? The retained earnings. So you have to be able to remember that. Then number 4, following the acquisition of Lima Limited, Lima Limited sold goods to KEEP Limited worth 160 million, which had originally cost, in this case, how much? 120 million. Of these goods, worth 48 million remained in KEEP Limited inventory at the year end. So therefore, in this case, it means you have to do what? Eliminate the intercompany sale of goods, and also in this case, calculate what? The unrealized profit on closing stock. So that's, in this case, adjustment number 1 we looked at. You can be able to check what we looked at. If there's an intercompany sale of goods, you eliminate them from, in this case, what? The cost of sales, and also in this case, what? The sales. Then also, if it happens these goods were still in stock by the end of the year, you have to calculate something we call what? Unrealized profit on closing stock. Then in this case, you debit what? The cost of sales, and also in this case, you eliminate from, in this case, what? The closing inventory. From the closing inventory. So number 5, there has been no impairments in the goodwill arising on KEEP Limited acquisition. All items within the profit or loss and the other comprehensive income statements are considered to accrue evenly throughout the year. The NCI in Lima Limited was valued at 400 million during the acquisition. We said when you see this statement, what does it mean? The non-controlling interest in Lima Limited was valued at 400 million during the acquisition. So of course you haven't actually been told fair value, but now in this case, that's basically the fair value of NCI. And then it means if you're having to, in this case, because you're having to be told you calculate what? Goodwill in Roman number 1. We'll use which method? We'll use the full method. We'll use the full method. Remember something I was having to tell you. When in this case, you hear the examiner has given you the fair value of NCI. It means in this case, the method you're going to use to calculate goodwill, it is the full method. It is the full method. And therefore, in Roman number 1, when you're calculating this goodwill, we'll be able to use in this case the method we call what? The full method. There are 2 methods, full method and partial method. And I told you the most common in the exam is the full method. It is the most common. That is normally in this case found in what? In the exam. Then in this case, Roman number 2, you come up with what? The consolidated profit or loss and the other comprehensive income for the year ended 30th of April 2024. Of so much importance, when in this case you see a group question, before you think about anything, GK, what you need to do, draw the group structure. Draw the group structure. The group structure, you'll always be able to get it from the first statement, the first sentence you're having to be given. What are you having to be told? For any group question, start with the group structure. Don't think about doing any other thing, but in this case, start with what? The group structure. So therefore, in this case, the group structure we have here, we can be able to draw it. The group structure we have here, there are 2 companies. We have KEEP Limited. You can either draw it the way you wish. You can draw it like this, or you can draw it like this. So let's draw it like this. You are told this KEEP Limited acquired 75% of the shareholding, in this case, in what? In this case, in what? In Lima Limited. Lima Limited. And therefore, this basically means what? This is what? A subsidiary. Exactly in this case, what? A subsidiary, because it is between what? 50%, more than 50% up to what? Up to 100. Up to 100. Then there's something you're having to be told. The acquisition was completed. This is now the elephant in the room. The acquisition was completed through a share for share transaction. So there's in this case what we call what? The purchase consideration. This is what we learned about in this case what? The purchase consideration. There's something called the purchase what? Consideration. This is basically what the parent company pays to acquire the subsidiary. Is what the parent company does what? Pays to acquire the subsidiary. So they can actually end up having in this case to pay what? Money. They can pay money. They can pay the purchase price. They can be able to pay the purchase price directly of the shares. Or they can do something we call a share exchange. They can do a share exchange, whereby they say maybe the value of this share of this company is so much higher. And therefore, in this case, they likely end up having to say we can exchange shares. That in this case, we can give you 2 shares. We can give you in this case 2 shares. 2 shares. Then you give us in this case what? 3 shares. We can give you 2 shares. Then in this case, you end up having to give us what? 3 shares. They can do a share exchange. They can do what? A share exchange. And therefore, in this case, the purchase consideration in this case was not in form of money. But now in this case, they did what? A share exchange. KEEP Limited agreed to give this Lima Limited some shares. While in this case, KEEP Limited took some shares in what? In Lima Limited. In Lima Limited. And at the end of it all, it was realized that in this case, KEEP Limited was able to control 75% of Lima Limited. And of course, that was what was in this case having to happen there. That was in this case what was having to happen there in that regard. And therefore, when you're having in this case to calculate the goodwill, so in this case you can be able to start having to calculate the goodwill. Then in this case I show you what in this case is having to happen. So in this case, if you're coming up with the goodwill, so goodwill computation. You can in this case start with what? The goodwill computation. So goodwill computation. Goodwill computation, that is Roman number 1. So we can be able to have shillings. So we can put shillings in thousands. Then shillings in thousands. Shillings in thousands. So you can in this case start with what? The PC or the purchase consideration there. The PC or the purchase consideration there. You can start with the purchase consideration. The PC. The purchase consideration there. We can start with the purchase consideration there. So you need to look at this statement very carefully. So you're having to be told that the acquisition was completed through a share-for-share transaction, where KIP Limited exchanged 2 shares for its own shares for every 3 Lima Limited what? Shares. For every 3 Lima Limited what? Shares. So what in this case it actually means, so for 3 shares in Lima, in this case, this KIP Limited was having to donate how many shares? 2. They were giving 2. For every 3 shares in this one, they were giving them 3 shares, while they give them what? 2 shares. While they give them in this case what? 2 shares. They give them in this case what? 2 shares. And therefore, how many number of shares were in this case in Lima at the date of in this case what? Acquisition. If you look at in this case the value of ordinary share capital, look at in this case not number 1, the value of ordinary share capital. So this is basically what? Lima, and this is basically in this case what? KIPA. So the number of shares in this case in Lima at this date of acquisition, in this case you can be able to take what? 640,000 divided by 10. You divide by 10 because now in this case, each and every share in Lima is having to go for 10 bob. Is having to go for what? In this case, 10 bob. And therefore with this one, we'll be able to know how many number of shares in this case were actually acquired in this case in what? In Lima. How many number of shares in this case were acquired in what? In Lima. So the total number of shares that in this case are actually in Lima, it is 640 over 10. But now they acquired what? 75%. They acquired 75% like that. 75% like that. So if you divide this one, you'll find that in this case, in Lima, this Lima, we have how many number of shares on the date of acquisition? Exactly in this case, because it is 64 million, but our figures are in thousands. Huh? So our workings here basically are in shillings of thousands. So it means in this case, those are 64 million what? Shares. So for every 3 shares they have, they are being given how many shares? 2 of them. They are being given how many shares of them? How many shares in this case? 2 of them. So what you are trying to calculate here are how many number of shares did KIP Limited give out, which in this case will become what? The purchase consideration is what they were paying them. For every 3 shares Lima has, they are given 2 by KIP, the parent company. They're given in this case how many shares? 2. And remember in this case, KIP Limited didn't acquire all of them because all of them are 64. They only acquired what? 75% of these shares. They only acquired what? 75% of these shares. So therefore, in this case, the number of shares acquired, therefore, number of shares acquired is equals to 75% multiplied by this what? 64,000. What do you get? To get the number of shares which were acquired by KIP, they didn't take the entire 100%. The number of shares in Lima Limited, you can get them. The total equity is actually 640 million. Each share is going for 10. So this basically gives us what? The total number of shares in Lima. But remember, this parent company didn't acquire all of them 100. They acquired 75%. So we can get those number of shares which are having to come to 64 million. But now they only acquired 75% of these shares. So how many shares did they acquire? You can be able to get it. So it's 75% multiplied by what? 64 million. What do you get? There's a figure you'll be able to get there. You're getting 48 million shares. They acquired 48 million shares. So these are the number of shares they acquired from, in this case, what? Lima. But for every 3 of these shares, they were donating to them how many? 2. They were donating to them 2. For every 3 shares in Lima they acquired, they were giving, in this case, what? Lima Limited, how many shares? 2 of them. This is what they were paying them. They were not paying them in form of money. They were paying them in form of what? Shares. What is our purchase consideration? What the parent company pays the subsidiary. What is our purchase consideration? What the parent company pays the subsidiary. They never paid them through money. They gave them shares. They told them, if you give us 3 shares, we'll be giving you how many shares? 2 of them. And in this case, how many shares did they end up having? In this case, to acquire them, they acquired 48, which is basically 75% of the total what? Number of shares. And then in this case, we can be able to get the number of shares which KIP Limited gave these guys. Because for every 3, they were giving them 2. What about for 48? Because they gave them totally 48. So the number of shares given out, we can be able to get it. We do what we call what? Cross multiplication. Hope you've been able to write this working here because I'm going to put it here. So you'll be able to, in this case, say 48, or you can also say 2 out of 3. Let's just do the cross multiplication. So this, like this, and this. So we'll be able to say in this case 48 48,000 over, in this case, what? 3 over 3 multiplied by 2. Multiplied by 2. These are the number of shares acquired. You can be able to get it. Then remember, you are told each and every share for KEEP Limited was having to go for 40 bob. At that particular point in time, they were having to do this kind of a transaction. The shares of this KEEP Limited were going for 40 bob. So these are the number of shares that KEEP Limited gave what? The subsidiary to pay them the purchase consideration. At that particular point in time, the market price of this KEEP Limited was what? 40. So that means ideally, if we convert these shares into money worth, we'll be able to get what they ideally paid what? The subsidiary. And therefore, in this case, you'll take the number of shares which in this case were actually acquired, were basically being given out. In this case, you multiply by what? The market price of the share at that particular point in time, which was having to go for how much? 40 shillings per share. You'll be able to get the purchase consideration. In this case, what is this? You'll be able to get a figure there. Hope you've been able to understand what has happened there. She's having to come to what? 1280. And so you're saying 1280. So 1280, in this case, it is 1280,000. Hope so. Is it 1280,000? 1280,000 what? Just give me the figure in full. 1280,000. Yes, 1280,000. It is 1280,000. So this is basically what they paid, but it was not in form of money worth. It was in form of what? Shares. And therefore it becomes what? The purchase consideration. It becomes the purchase consideration. So in this case, the PC can actually be in form of money, or they can be able to give them shares, and they do what we call what? A share exchange. So ideally, if we put these shares they gave this Lima in form of money, it will come to this. It will come to this. Then we said in this case, if you've been given the fair value of NCI, you'll in this case end up having to use what? The full method. You use the full method, and you've been given the fair value of NCI in not number, in this case what? 7. So therefore in this case you have to put here the fair value of NCI. Remember our format. Fair value of NCI. Remember our format. We said in this case you take what? The PC, you add on the fair value of NCI, which in this case you've actually been given in note number 7. It is how much? 400 million. Remember, in this case, you have to put in what? Thousands. So you need to remember to put in thousands. Don't put there 400. Remember to put in what? In thousands. Remember these zeros there? There's something they're having to make. So it will actually in this case be what? Be 400,000. So like that. 400,000 like that. Then in this case, we do what? We less the net assets acquired. In this case, you can be able to less net assets acquired. You can less the net assets, like in this case, were acquired. The net assets acquired. So we add the fair value of NCI. We add the fair value of NCI. We add the fair value of NCI. Then in this case, we do what? We less the net assets acquired. The assets that were acquired in this case were in this case belonging to what? Lima. So what you do, you go in this case to what? The equity part of Lima. The equity part of Lima. And of course, you can be able to see it in additional information number 1. You go to the equity part of, in this case, what? Lima. So what you're having there is in this case, what is actually what? The ordinary share capital. You've been given the ordinary share capital, which in this case is actually 640. 640. There's no share premium. So let's not in this case start imagining what is not there that is must be there. There's no in this case what? Revolutionary reserve. But in this case, you have what? The equity reserve. You have in this case what? An equity reserve. In this case, you have what? An equity reserve. So in this case, you put all the reserves, equity reserve. Equity reserve. So in this case, it is actually 8,800. Then you have what? Retained earnings. You have in this case what? Retained earnings. Retained earnings on the date of acquisition. Retained earnings on the date of acquisition. In this case, it's exactly how much? It's actually 500,000. So in this case, retained earnings is actually 500,000. So you're supposed to add them. You're supposed to add them. You're supposed to add them so that in this case, you can be able to get a total. You're supposed to add them to get a total. You're supposed to add them to get a total. What do you get as the total? Just add 640,000 plus 88 plus 500. You'll get what do you get? 1148,800. 1148,800. You deduct. When you deduct, in this case, you'll get the goodwill. You'll get the goodwill. You get the goodwill. You need to deduct in this case to get what? The goodwill. You get the goodwill. When you deduct, you'll be able to get the goodwill. There's a figure you'll be able to get. You need to add this, then you deduct this, because you're saying less net assets acquired. These were the net assets on the date of acquisition. On the date of acquisition. So you can be able to call them the net assets in the date of, in this case, what? Acquisition. You get 531,200. So 531,200. 531,200. So there's something in this case you are told is not number. There's a note there. There's in this case not number. Not number 5. You are told that there has been no impairment in goodwill arising from KEEP Limited acquisition of Lima Limited. If in this case you are told there was any form of impairment, because this is an asset. This is an asset. It's an intangible asset. Intangible assets don't depreciate. They are normally impaired. So if it was impaired, you would have been told. If you would have been told, you would have considered it here. You would have said less impairment. But it is not there. So it means our figure will just be able to end here. Sometimes you can be told that the goodwill was having to be impaired at maybe 2%, 3%. Sometimes you can be told that. But in this case, there was no any form of what? Impairment. And therefore, it will just remain as what the way it is. You've been able to calculate. You've been able to calculate. You've been able to calculate. So that's why in this case, you calculate what the goodwill. And remember this one now, you need to indicate there. It will appear as an non-current asset. It will appear as an non-current asset in the statement of financial position, the consolidated statement of financial position, as an NCA in the consolidated statement of financial position, which in this case, you've not been told to prepare in this question, but you have to take note. The goodwill that you calculate normally appears as a non-current asset in the combined statement of financial position. In the combined statement of, in this case, what? Financial position. So I can see James is having to say that in this case, I do what? I repeat in this case what? The PC. So listen in this case to the introduction paragraph. I'm going to repeat again what is having to happen there regarding the PC. So for this case, this KEEP Limited acquired 75% of what? Of Lima. But they didn't pay them money. They gave them what? Shares. So we need to give, in this case, to get what? The worth of these shares. They gave them, it was how much? They told them, we won't give you money. We will give you shares in our company. So we have to value these shares at the date we were having to give them. They were how much? We've been able to calculate. We've gotten this worth of the shares. At that date they were having to acquire them. It was 1280. So the question here is you have to find out how many number of shares did they end up having to give them and what was the value. For the value being told, it was 40 shillings per share. That's what you're having to be told. On the date of acquisition, KEEP Limited share price was having to go for 40. On this 1st of November, when they were acquiring them on the stock exchange, whatever. In this case, these shares for KEEP Limited were going for 40. They told them, we won't give you money. On this date, we're going to give you our shares. The question here is now, in this case, you have to know what was the value of these shares. It becomes the purchase consideration. What is our purchase consideration? What the parent company pays to acquire the subsidiary. It can be shares, it can be money. In this case, they never paid them money, they gave them shares. The question is, you have to find out how many shares did they give them and what was their value. That becomes what? The purchase consideration. You've been told, in this case, for every 3 shares, Lima Limited was having to give KEEP. KEEP Limited was giving them how many? 2. For every 3 shares, Lima Limited was having to give KEEP. They were having to give them, in this case, how many shares? 2. So in this case, for every 3 shares in Lima, KEEP Limited was having to donate how many shares? 2 of them. To donate 2. And then in this case, you have to find out how many shares did KEEP Limited give what? Lima. Did KEEP Limited, in this case, end up having to give what? Lima. So you have to find out how many shares are in this case in what? In Lima, like that. Are in Lima. Because for every 3 they give them how many? 2. How many shares are there? We can be able to get it. Look at note number 1. You are told the ordinary shares, each is having to go for 10 shillings. And in Lima, the ordinary share capital worth, it is 640 million. We can know the number of shares in this case in what? In Lima in totality. How do we get it? We take the total ordinary share capital, divide by the price per share. These are the total number of shares in Lima. We can get them. These are the total number of, in this case, what shares in Lima. Which in this case, if you divide, you get 64 million shares are there in Lima. What have you been told initially? For every 3 shares inside this one, Keep Limited was giving them 2. And of course, you can be able to get it because we normally do what? Cross multiplication. Remember that? Cross multiplication in mathematics. So in this case, you say for every 3 shares, they are getting 2. What about for a total of 64 million shares? You cross multiply 64 times this, divide by, in this case, what? 3. But in this case, you've been able to say, remember, they never acquired all the shares. They acquired what? 75%. And therefore, the number of shares acquired, in this case, in Lima Limited, we can be able to get them. We take 75% of the total equity shares in what? In Lima. That's what Keep Limited took. They took, in this case, how many shares? 48 million shares. So for every 3 shares in Lima, they were giving them 2. What about for 48 million shares they took? We cross multiply. This is what you are calculating here. Ideally, we can erase this calculation and put here 48 million, but we have to show how we are having to get it. We can erase it and put here what? 48 million. So ideally, we just need to do what? You cross multiply. This is what you've done here. You cross multiply. In this case, for every 3, they are getting 2. What about for 48 million shares? How many shares are they having to get? You cross multiply. You'll get the number of shares in this case. Keep Limited donated, in this case, to what? To Lima as the PC. But remember, these are just shares. We have to get the money worth. In this case, we have to multiply by the price per share. In this case, we get how many worth of the shares they ended up having to give what? Lima Limited in money form. These are just the number of shares they gave them. We have to get it in money form. We multiply by the price of the shares of Keep Limited on that date of acquisition. The price of shares of Keep Limited were going for 40 shillings. So that is what? The purchase consideration. That is the purchase consideration. So in this case, you can now be able to go to what? To the second part, but because there'll be a number of calculations that you'll be able to do. So one thing in this case, I have to indicate here, also on the group structure, remember to put the date of acquisition. In this case, it was what? 1st of November 2020, is it 2023? 2023. Then also you have to, in this case, take note of the date of, in this case, what? The financial statements are having to be prepared. For example, in this case, you've been told that we prepare financial statements as of 30th of April. As of 30th of April 2024. This means this subsidiary existed for how many months? This was the date of acquisition. And we are preparing financials as 30th of April 2024. It existed for how many months? For 6 months. It was in this case for 6 months. So initially on the group structure, also be able to show this. So that in this case, when you are preparing, for example, the income statement, you'll be able to know the items in the subsidiary, I will apportion them accordingly. In this case, 6 out of 12. You'll apportion them accordingly, 6 out of 12. Because it existed for how many months? Only 6 months. So if in this case it is sales we are having to add, you will add, of course, but now in this case, once for the subsidiary, you apportion them. Because now in this case, it only existed for 6 months in the group. As a member of, in this case, of the group. For example, what you've been given there as revenue, it means you'll be taking 1,800 plus 6 out of 12 times 960. For the cost of sales, you'll be taking 1,040 plus 6 out of 12 times 440. This one being this subsidiary existed as a member of the group for only how many months? 6 months. If it happens, the subsidiary was acquired in between 2 financial reporting dates. Make sure in the consolidated income statement, you apportion the items in that statement for the subsidiary. So it means in this case, for the parent company, you're taking the entire amount. But now in this case, for the subsidiary, we'll likely be taking 6 out of 12. We'll have to apportion it according to the time period it existed as As a member of the group. Remember, in this case, The parent company ni mzazi. So yeye unamchukua fully. Kwa sababu in this case, he has been there always. But now in this case, he has gotten a child. Now in this case, we start apportioning for this child from the date of, in this case, what? Acquisition. That is what in the income statement. But in this case, for the assets and liabilities, you just add them line by line. Line by line. So we can be able to do a number of calculations here before we actually end up having to come up with what? That consolidated income statement. There are just only two. The intercompany sale and the intercompany sale of what? Fixed assets. The intercompany sale of goods, and in this case, what? The intercompany sale of fixed assets. So we can in this case do a working there. We can do a working there for the intercompany sale of goods and the intercompany sale of what? Of the fixed assets. So that is in this case what? Not number 2. Not number 2, we can be able to have a working. Not number 3. So not number 3. Not number 3, we can be able to have a working. So working 1. So not, it is actually not number 3. It is actually what? Intercompany sale of fixed assets. Intercompany sale of fixed assets. Intercompany sale of, in this case, what? Fixed assets. So this is what you're having to be told. After acquisition on 1st of November, KEEP Limited transferred a plant equipment to Lima Limited at an agreed value of 20 million. This equipment had a carrying amount of 16 million at the transfer date. So in this case, it means in this case they sold the equipment. They sold the equipment. So they sold it. They sold the equipment at, in this case, what? A value of 20 million. So a value of 20 million, and we would say 20,000 because our workings are in that. Then the cost of this equipment, the cost of the equipment was in this case how much? 16 million. It was actually in this case how much? 16 million. Was in this case actually 16 million. Was actually 16 million. 16 million. And then in this case, it means they actually made a profit of how much there? They actually made a profit of, in this case, how much? 4 million. The profit there, the profit was in this case how much? 4 million. There was a profit of, in this case, how much? 4 million. There was a profit of, in this case, how much? 4 million. There was a profit of, in this case, what? 4 million. So the profit on the sale in this case was how much? 4 million. Was actually 4 million. Was actually 4 million. In this, we said in this case, this profit. So in this case, this profit, how do you deal with it? This profit, how do you end up having to deal with it? You said you eliminate it. You eliminate that profit that in this case was there on the sale of what? Of the fixed asset. So therefore, in this case, to eliminate it, you likely end up having to debit the cost of sales. You likely debit the cost of sales, or in this case, you say what? The retained earnings. The retained earnings with that 4 million. Then in this case, you credit the property, plant, and equipment with that what? 4 million. With that, in this case, what? 4 million. With the 4 million. Then in this case, you have to calculate what? The depreciation what? Depreciation overcharge. Depreciation overcharge. In this case, depreciation overcharge. The depreciation overcharge. You have to calculate the depreciation overcharge. In this case, this is what you're having to be told. This equipment had a carrying amount of 16 million at the transfer date and a remaining useful life of 2.5 years. A remaining useful life of, in this case, how many years? 2.5 years. And therefore, the depreciation here per year, you have to calculate it. You'll take in this case what? The profit on the sale, you divide by the useful life. You divide by the useful life, you'll be able to get 4 million divided by 2.5. You divide by 2.5 to get what? The depreciation overcharge. Depreciation overcharge. So here we were getting what? The profit on the sale. Profit on sale of the fixed asset. So here we are having to get what? The depreciation what? Overcharge. Depreciation overcharge. So you take in this case what? The profits on sale. You in this case divide by the useful life. So you divide by that, you get what? You get 1600 or something. You get 1600. You get 1600. Exactly in this case is equals to what? 1600 is equals to 1600. So this means in this case, per annum, in this case, per annum average, in this case, this asset was having to lose how much? 1600 on that depreciation overcharge. But in this case, remember, you need to remember that this particular subsidiary, they actually sold in this case to the subsidiary. They actually sold to the subsidiary, and therefore this subsidiary was having to recognize the asset at what? At 20. And this subsidiary existed for how many months? Only 6 months. It existed for only 6 months. It means this profit you're talking about is being recognized where? In the subsidiary. Because that's basically what in this case what happened there. So KIP Limited follows after acquisition, they transferred a plant equipment to Lima Limited at an agreed value of 20. So they directly sold to them at 20. And therefore, this extra 4 million is actually basically being recognized where? In Lima Limited. And remember, Lima Limited has only existed for 6 months. And then it means this one we have to apportion. We'll take 6 out of 12. We'll take in this case what? 6 out of 12. 6 out of 12, which in this case will likely end up having to be 800,000. So with this one we said we'll likely in this case debit the property, plant, and equipment. Then in this case you credit the cost of sales. So it will just basically reverse. It will likely end up having to reverse. You debit the property, plant, and equipment. You remove this overcharge. It was an overcharge, which in this case was there for like half a year. So you remove it from the property, plant, and equipment. Then also in this case, you end up having to do what? Remove it from, in this case, what? The expenses. When in this case, you credit the cost of sales, you are removing it as an expense. They had overcharged. You know, the term is this one. They had overcharged depreciation. They were calculating depreciation on 20 million rather than having to calculate on what? On 16 million. They were calculating on 20 million rather than having to calculate on 16 million. And therefore, this profit which they had included in the cost of this asset, which we are removing here, you know, we are removing this 4 million from PPE. The PPE had actually been overstated. So we are reducing it. When you reduce it, it means in this case also we have to consider what? The depreciation on this overstatement. So we need to calculate that depreciation on this what? Overstatement. And therefore, when you do that, you'll likely end up having to realize that in this case, they had actually overcharged what? Depreciation. They were calculating on 20 million and not 16 million. Since you've corrected the PPE, you also have to consider what? Correction of the depreciation what? Overcharge, which in this case you can be able to calculate it. So you take that profit that was basically they were calculating depreciation on, you get how much was the depreciation. Then in this case, we eliminate it from, in this case, what? The cost of sales. It was basically considered under what? The cost of sales or as an expense. When you credit the cost of sales, you are reducing that depreciation expense. You are reducing it. There was an overcharge, you are eliminating it. And therefore, you credit. When you credit an expense account, ideally in this case, you're having to do what? You're having to reduce that expense. You are reducing it. When in this case, you debit the PPE account, in this case, you are increasing it because they had overcharged, and then we need to correct. That's basically what is having to happen. And you said in this case, you do what? You debit property, plant, and equipment, and you credit what? The cost of sales. So that's what in this case will happen if you have in this case what? An intercompany sale of what? Of a fixed asset. So take note, in this case, you calculate the profit on the sale, you debit cost of sales. Then in this case, you credit what? PPE to eliminate that profit. Then in this case, because there was in this case an overcharge in the PPE, there was a depreciation overcharge. You also in this case need to do what? To correct it. How do you correct it? You likely in this case increase it back in the PPE, you debit it, and then in this case you reduce what? Your expenses. You credit what? The cost of sales. Because in this case, it was recognized as part of the expenses. Yet it was not supposed to be there. It was an overcharge by mistake. We need to correct it. So we correct it by having to enter this kind of what? Entries. So in this case, it means when you are calculating the cost of sales, we likely end up having to add this amount. Then in this case, we do what? We deduct this amount. You see the cost of sales we'll be able to have. We'll say for the parent plus the subsidiary, then we add, because debiting is basically adding. This one is basically adding. When you debit an expense account, it means you are adding it. When you are creating it, it means you are having to deduct it. We deduct from, in this case, what? The cost of sales when you are consolidating. So that's why in this case, you'll be able to deal with what? Not number 3. If it's an undercharge, in this case, it will be the opposite. If it's an undercharge, it will be the opposite. It will be the opposite. We'll likely end up having to do what? We'll likely end up having to credit. We'll likely, in this case, credit what? Credit the PPE. And in this case, end up having to do what? Debit the cost of sales. It will be the opposite. It will be the opposite. So because now in this case, you're likely undercharged, you reverse these accounts. It means in this case, you debit the cost of sales. Because an undercharge simply means in this case, what? You had actually understated what your expenses, but now you need to correct them by moving them up. So you debit the cost of sales and you credit what? The PPE. You do the opposite with an undercharge. But the most common in the exam, it is this one. That is the most common. It is the most common overcharge. But if in this case it's an undercharge, you just do the opposite. You will debit what? The PPE and you credit what? The cost of sales. You likely in this case credit what? You credit the PPE and you debit what? The cost of sales. You reverse those accounts. It will be the opposite way. It will be the opposite way. So that's what will happen in this case. It is exactly what? An undercharge. Is an undercharge. So we can in this case look at what? Note number 4, which in this case was what? An intercompany sale of goods. An intercompany sale of goods. Intercompany sale of goods. So you see an intercompany sale of a fixed asset. Those are the standard entries. You need in this case like to master them. You need to like to master them. There's no any other way. You'll have to master them. You'll have in this case to master them. When you see an intercompany sale of a fixed assets, profit on the sale, how do I treat it? Which one do I debit? Which one do I credit? The overcharge, which one do I debit? Which one do I end up having to do what? To credit. You'll have to master it. You'll have to master it because there's just a standard way the examiner will be able to test that concept. You'll have to master it. So in this case, you can go to what? The intercompany sale of goods. In this case, you have note number 4. You can have in this case working 2, note number 4. Note number 4, which in this case is what? An intercompany sale of goods. Intercompany sale of goods, which has an element of what? Unrealized profit on closing inventory. It has an element of unrealized profit on closing inventory. So following the acquisition, Lima Limited sold goods to Keep Limited worth 160 million, which had originally cost Lima Limited 120 million. So in this case, we have to, in this case, what? Eliminate the intercompany sale. Eliminate the intercompany sale. Or in this case, what? 160 million. Is 160 million of 160 million. So, and how do we end up having to deal with this? You will debit in this case what? The sales account, and you credit what? The cost of sales. In this case, you likely end up having to debit. You likely end up having to debit the sales account. In this case, you will debit the sales account. But in this case, what? The 160. This basically means you are deducting. When you are debiting a sales account or an income account, it means you are reducing it. You are deducting. Then in this case, we credit the cost of sales account by the 160. This means what is happening, you are still having to do what? Deduct. When you credit an expense account, you are reducing it. When you are debiting it, you are increasing it. When you debit an expense account, it means those expenses are increasing. When in this case, you talk about having to credit, it means you are reducing it. For an intercompany sale, this is the standard entry. You'll have to master it. You reduce in this case what? The sales, and also you eliminate from in this case what? The cost of sales. There's no any other way the examiner will test this one differently. You'll basically test it like this. So you just have to, like in this case, master it. For any, when you see an intercompany sale of goods, we are removing from the sales and we're removing in this case from what? From the cost of sales. Because it's basically a sale to the same member of the group. The same member of the group. We have to eliminate the intercompany sale. Then sometimes there can be an element of, in this case, what? Unrealized profit on closing inventory. This one arises when you hear the language of the examiner having to say that out of these goods that were sold, part of them, they can tell you half of the goods were still in stock by the end of the year. They can tell you half of the goods were still in stock by the end of the year. They can tell you something like that. Half of the goods were still what? In stock by the end of the year. So you'll have to, like in this case, be able to know they want in this case to do what? To calculate the URP on closing inventory. They want you to calculate the URP on closing inventory. And therefore, this is what you're having to be told. Following the acquisition, Lima Limited sold goods to KIP Limited worth 160 million, which had originally cost Lima Limited 120,000. Of these goods, 48 million remained in KIP Limited inventory at the year end. In this case, remember, you have to remember we said that for URP, in this case, you'll end up having to take what? You will take in this case what? The margin. In this case, you end up having to take the margin. You take in this case what? The margin. And in this case what? The value of the goods that in this case was still actually what? In stock. So these goods worth 48 million remained in this case, it remained in KIP Limited inventory at the year end. So in this case, we'll take the margin multiplied by what? By the closing inventory. But now in this case, you don't know the margin. You'll have to calculate it. You don't know the margin. So how do you get the margin? How do you get the margin? In this case, margin is equals to the gross profit. You divide by, in this case, by what? By the sales. Multiplied by 100%. So we can be able to get the GP. Because in this case, how do you get the GP? You take the selling price minus, in this case, what? The cost of sale. The selling price minus the cost of sale. The selling price of these goods was, in this case, how much? 160 million. It was 160. Then in this case, the cost of these goods, they actually cost, in this case, how much? 120. Then we divide by the selling price, 160. Then in this case, we multiply by what? By 100%. What do you get? So the selling price of the goods that were being sold by Lima to KIP was 160, but they cost them 120. So this basically will give you the GP. So because how do you get the GP? You take the selling, you minus what? The cost. So you get the GP, then you divide by the selling price, which was 160. Then multiply by 100%. You get what? 25%. You will get 25%. So that in this case, you can comfortably, in this case, be able to get what? The URP, because you've gotten what? The margin. And therefore, the URP will likely be equal to what? 25%. We multiply by what? 48, because this was what basically was still likely what? In stock. And that in this case, you can be able to get what? You'll get the URP. What was the URP? What was the URP on closing inventory? It was 12,000. It was in this case 12,000. So remember the other language the examiner can be able to use. He won't tell you that 48,000 are still in stock. He'll tell you half of these goods are still in stock. So that means you'll take a half of these 160. Or he can tell you a quarter of these goods were still in stock by the end of the year. So if it is a quarter of these goods were still in stock, to get in this case the closing inventory, you will simply take a quarter times 160. He normally likes using that language. Half of these goods were still in stock by the end of the year. Half of these goods were still actually in stock by the end of the year. So they normally combine the concept like that. So they'll tell you half of the goods or quarter of the goods, but here he told you exactly 48,000. He just gave you the figure. He didn't want you in this case to do what? To struggle, having to do what? To think. So what did we say we treat? How do we treat this one? Which one are we debiting and which one are we having to credit? A coil. When in this case you calculate the URP on closing inventory, which account are we debiting and which one are we having to credit? You don't have to think, you just have to open back your notes and you will see what we said we are supposed to do. You don't have to start thinking so hard. You just open your notes. And in this case, you'll see what we said you'll be able to do with this kind of what? URP. You debit the cost of sales and you credit what? Closing inventory. You debit. You need to write it here. You need to write it here. You debit the cost of sales and in this case, you credit what? The closing inventory. The closing inventory. The closing inventory, you normally find it in the statement of financial position. The consolidated statement of financial position. The cost of sales, you normally find in the consolidated income statement. You normally find it in the consolidated what? Income statement. That's why in this case, you normally do what? Find it. You normally find it. And therefore, there's no any other calculation. It means in this case, we can comfortably, in this case, try to do what? Come up with what? The consolidated statement of what? Profit or loss. There's no any other calculation. There's no any other calculation. So we already in this case be able to use note number 7 in the calculation of what? Of goodwill. Of goodwill. And therefore, anything here basically you've calculated that is touching on an item in the income statement. When you are consolidating, you have to make what? The relevant adjustments. When you are consolidating, you have to do what? Make the relevant adjustments. And then we can be able to now come up with what? the consolidated income statement. Let's in this case try to do it for the very first time, so that in this case you can be able to see when now we are consolidating, how do we do it? When now we are consolidating, how do we do it? How do we combine the figures now? Hope you've been able to write that, because I'm grabbing. So the key computations: intercompany sale of fixed assets, intercompany sale of goods, calculation of URP on closing inventory. Those are the most common concepts that in this case, the examiner will put in the additional information of group accounts. You can in this case you can't in this case afford to fail to understand how you can be able to calculate them. You need to master, because they are the most commonest in this case concepts in this case consolidated income statements. They'll in this case always be there in a question concerning the CIS, or in this case the CSFP. And then in this case you can be able to come up with this one. So we call this one It is KEEP limited group. It's KEEP limited group. KEEP limited group. So in this case it is KEEP limited group. KEEP limited group consolidated. KEEP limited group consolidated. Statement of profit or loss consolidated. Statement of profit or loss. When year ended, it is 30th of April 2024. 30th of April 2024. And therefore, it is going to be very simple. It is going to be very simple, very simple. We start with what? Revenue. We start with the revenue, so we can in this case be able to have our shillings here in thousands. We are dealing with a lot of money, not little money, a lot of money. We start with the revenue. So you'll in this case take the one in this case for what? For the keeper, you'll say 1800 plus 6 out of 12. 6 out of, because it was existing for 6 months. Remember, we have emphasized under the NB, we apportion according to the time period the subsidiary existed. According to the time period, Lima Limited existed. It was 6 months. And then we'll take 6 out of 12 times 960. 960. But remember, we've been able to make a number of adjustments here. So on the revenue, what are we going to do about it? Who can be able to tell us? What are we going to do about it when you are consolidating? We've been able to make a number of adjustments here. On the revenue, in the workings, there's something you've been able to say. In this case, you'll be able to do about, in this case, what? The revenue. We will less what? We will less the intercompany sale, which was in this case what? 160. It was in this case what? 160. It was 160. Then in this case, you need to less. There's a figure you look at. There's no any other adjustment. There's no any other adjustments that is there. So that's the only one. We eliminate that 160. What will you be able to get? You can do the computation. Just do it. Just take your time. So 1800 plus 6 out of 12 times 960. Then minus, you eliminate that intercompany sale. You get 2120. This is get 2120,000. So 2120,000. So you're able to get it like that. 2120,000. So like that. 2120,000 like that. 2120,000 like that. Remember, these ones I've reduced them by 6 zeros. So I've reduced them by 6 zeros. You can put them if you wish, so that you don't get confused. You can say 1.8 plus 960,000 minus 160,000, because I've reduced them by 6 zeros. You can be able to ensure these ones are reduced by some zeros there. I've reduced by some zeros there. So it comes to 2120. So you can go in this case to what? The cost of sales, and go to cost of sales. You repeat the same. You just repeat the same. You take 1040 plus 1040. It will be 1040 plus 6 out of 12 times 440. But now there are some items we've been able to say that they affect. There's the intercompany sale, 160. There's the unrealized profit on closing inventory, which in this case we've gotten as what? As 12. Unrealized profit on the closing inventory, which in this case we've actually gotten as what? As 12. Unrealized profit on closing inventory, which in this case we ended up having to get as what? As 12. So you need to add that 12. You need to add the 12. What else are we having to adjust? There's the depreciation in this case, what? Overcharge? Or in this case, how much? Is it 800? Is it 800? Depreciation overcharge of in this case, how much? 800. So you need to minus that 800. You need to minus that 800. Now in this case, it will be 0.8 because I'm reducing my figures. 0.8. Then in this case, there is what? The profit on the sale of the fixed asset, unrealized profit on the sale of the fixed asset, which was in this case having to come to 4 million, 14 or 4 million, which in this case you'll have to add it here. So 4. You'll have to add it here 4. It was 4 million. It was having to come to 4 million. So we need to adjust all those ones. So it is 1046 out of 12. Eliminate the intercompany sale, which you've been able to say, you do what? You will credit, in this case, what? The cost of sales. There's the unrealized profit on closing inventory, which you say you debit the cost of sales. There's in this case what? The depreciation overcharge, which in this case you said you credit the cost of sales. When you credit the cost of sales, it means you are deducting. Then there's what? The unrealized profit on the sale of the fixed asset, which was 4. So there's a figure you'll be able to get. Are you getting? $11, $15, getting $11, $15, $200. So $11, $15, $200. So $11, $15, $11, $15, $200. So therefore you can be able to deduct to be able to get what? The gross profits. You can get the consolidated gross profits. Gross profits. And be able to get it. So there's a figure you'll be able to get. Then now we can be able to go to what? To admin expenses and distribution. These are some of the items that don't have a lot of calculations. These are like free marks. You just adjust them the way they are. So you'll take 94.4 plus 6 out of 12. 6 out of 12 times, in this case, 48. Then you go in this case to what? To admin. Admin. You just do the same. These ones don't have any other adjustments. You just pick them the way they are normally free marks. They're normally free marks, these ones. These are now the low-hanging fruits. These are now the low-hanging fruit. They don't have any kind of confusion in calculations. Intercompany, blah, 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 intercompany sales, they don't have. But now in this case, remember these ones in published, sometimes they are normally adjusted. But here in group, rarely. In fact, I haven't come across a question calling you upon to do a lot of calculations on this one in the group. These ones are normally free marks. So you just need, in this case, to do a COIL, you just need to apportion. You make sure you apportion. Once you apportion that, that is a free mark. So you might miss out. Maybe this one has a lot of adjustments. This one majorly it is normally in this case what the intercompany sell, the revenue. That is like the only adjustment that will be there. But this one, cost of sales, it has a lot of adjustments, my friend. It has a lot of adjustments, my friend. So you can see there are so many of them. But this one, it is mostly normally what the intercompany sell. You eliminate it. For these ones, rarely, in fact, I haven't come across a question. When you do the illustrations, you'll be able to see rarely we'll adjust these ones. What you need to take care of is the apportionment here. Then you pick the mark. You pick the mark. That's why you're having to say you can't score 0 a COIL. In what? In group, still in group, you can't score 0. You can see how interesting it is. They're just some free marks that are normally there. Even though it seems to be a bit hard, you can pick some low-hanging fruits there. But in this case, you can just easily score the mark like that. Just like that. So for the GP, how much are you having to get? The GP you are getting how much? For the GP you are getting 10,04,800. 10,04,800. 10,04. 10,04 is 10. 10,004. 10,004. 800. What about in this case the distribution? What about distribution? Distribution, you are getting how much? Distribution. Remember my figures here, I've told you I've reduced by zeros. It means each and every figure I put here has some 3 zeros, like that. So I've reduced that. You can see I've indicated up here. But in your book, you can put all of them so that you don't get confused. So you can put all of them. For me, I've been reducing to zeros. So what are you getting when you calculate for distribution? Take your time. You just take your time. Slow but sure. Slow but sure. Slow but sure. And you just take your time. So it is coming to what? 118. 400. So 118, 400. 118, 400. Then you go to admin. Go to admin. Then you go to what? Finance. Also, finance is another free mark. Finance is another free mark. Just free mark, free mark. This examiner sometimes, he can sometimes try to frustrate you, but in some areas, it's just very fair. This examiner is just very, very fair. So 6 out of 12 times, 6 out of 12 times, exactly 6, 6 plus 6 out of 12 times 4.8. So what about in this case for admin? What are you getting for admin? For admin you are getting, I can tell admin you are saying 154,000. 154,000, 154,000. Remember, these ones are expenses when deducting. What about for finance cost? What about for finance cost? What about for finance cost? For finance cost, you're getting 8,400. So in this case, it is 8,400. 8,400. You can be able to deduct, so that in this case, you can be able to get the what you're having to call what profit before tax. So that we can be able to get the profit before tax. The profit before tax. What are you getting? You need to deduct now. You need to deduct to get the profit before tax. The profit before tax, 724,000. I'm just saying 724,000. 724,000. You go to the income tax expense. Income tax expense was bringing us trouble in cash flow. Just imagine here, in group is also in this case another free mark that you'll end up having to collect. In group is a free mark. It is a free mark. You simply just take 192. James, you just take 192, then you add on 6 out of 12. Can you fail to get 6 out of 12? Imagine, James. Can you fail to get it? You can't fail to get it. But now I've been able to tell you the trouble would be if you don't identify this 6 month. That's when in this case things go marambas. You just basically be adding 192 plus that one without apportioning. Then in this case, you smile and say, this exam, I've clobbered it. Yet you forgot date of acquisition. The dates are usually very important in the question. Never ignore them. Try to get what they are having to mean. When you see the examiner has put a date, don't ignore it. Look at that date. What is it having to mean? There's something it's having to mean. In this case, in group accounts, you have to, in this case, be so much concerned about what? The date of acquisition and the financial reporting date. The date of acquisition and the financial reporting date, it will give you this period. If you miss out on that, then in this case, you just basically be saying 94.4 plus 48. Then you come out of that exam smiling, that in this case, you clobber it. Yet, you've gotten 0 out of all of them, imagine, because you forgot about what? The 6 month. You forgot about what? Apportioning those what? Expenses. So for this one, you'll take 192 plus 6 out of 12 times 101.2. There's something you'll be able to get here for the income tax. Income tax, you're getting how much? 247,600. So 247,600. Remember this one, you're also deducting 247,600. So you deduct. In this case, get what? The profit for the year. Again, in this case, the profit for the year. Profit for the year. You get the profit for the year. Is a figure you'll be able to get there. Then you can be able to consider what? The other comprehensive incomes there. You can be able to get the other comprehensive incomes. What are you having to get as the profit for the year? You're getting 476, 476, 400. 476, 400. So 476, 400. And in this case, you can go to what? The other comprehensive incomes. You can go to the other comprehensive incomes. Other comprehensive incomes. Other comprehensive incomes. So for this one, we have gain on revaluation of land. Gain on land revaluation. So for this one, look at note number 2. Look at note number 2. Look at note number 2. So let's just go through it very keenly. Note number 2, it says, KIP Limited follows a policy of revaluing land to market value at the end of each and every reporting period. Lima Limited had previously measured its land at historical cost before being acquired. Since acquisition, you need to underline that statement. Since acquisition, Lima Limited land increased by 4 million in value, which it has recorded in its financial statements. And in this case, remember when you are reading the question, I told you that is the amount that has actually been shown in the statement of income for Lima Limited. So what it means in this case, we won't apportion. Have you seen where I'm having to tell you underline? Underline where they're having to say since acquisition. Since what? Acquisition. Since when they acquired is when the value has gone up. So it means that evaluation won't actually end up having to do what? Apportion it. For that one, you just be able to take it the way it is. Because they have told you since what? Acquisition. So since acquisition, the value of the land has actually been able to go up. So you'll be able to say 10 plus 4. So this one you get what? 14. 14. Then we go to the other one. The other one you haven't actually been told anything. We'll be able to apportion. We'll apportion because you haven't been told anything. Loss on fair value, what? Or financial equity. Loss on fair value. Loss on fair value. So for that one, we'll be able to say 2,800. We'll say 2,800. 2,800 plus 6 out of 12 times 1,600. Times 1,600. So we'll be able to get a value there. So this one comes to what? 800. Comes to 800. Comes to 800. So that means it's 3,600. 3,600. I think it will be 3,600, which in this case will deduct. So like that. So with that, then in this case, you can be able to get a total comprehensive income. The total comprehensive income. We get a total comprehensive income. Total comprehensive income, which comes to how much? You need to take in this case 476,400 plus 14 minus 3,600. You'll be able to get a total comprehensive income. The total comprehensive income is coming to I can still say 486,800. So 486,800. 486,800. So that's basically in this case, you would have actually been able to prepare what? The income statement. You would have actually been able to prepare the income statement. The income statement. So that's how you come up with the income statement. The income statement. So the major adjustment will normally have to be on the cost of sales. Will be on the cost of sales and maybe sometimes the revenue. So revenue is in this case, this is the major one, intercompany sale. There's an intercompany sale. It will affect the revenue. But cost of sales is probably the figure that will give you a lot of trouble because it has so many adjustments. But the others, they are sometimes in this case just very direct. Like marks, you can just be able to collect it. Because I can see this one don't have major adjustments. They don't have major adjustments. It means if you are very keen, you'll easily scoop this one, 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 you'll easily scoop this one. You'll easily scoop that one. Because this one majorly what you'll be able to see in most of the questions, what affects it is normally what the intercompany sell, which you have to eliminate. You have to eliminate the intercompany sell. But this one, distribution, admin, if they are there, then you thank God. What you just in this case need to be able to know when was the subsidiary acquired. Then in this case, you can actually be able to do what? Add them line by line, add them line by line. So I want us in this case, we look at just two items, which in this case now are the ones that will be able to give us the basis of having to come up with now the statement of financial position. They'll give us the basis of now having to be able to come up with what? The statement of financial position. There's also in this case, we call what? The non-controlling interest and what we call the retained earnings. The non-controlling interest and what we call what? The retained earnings. Where did the 10,000 on gain on land come from? It is in the question. You mean you cannot be able to see it? It is in the question. Look at the income statement for KEEP. It is there. Yes, you've seen it. You've seen it exactly in the question. It is in the question. So when you're coming up with the consolidated, remember this one is the consolidated what? Income statement. It is the consolidated income statement. And we've been able to say that there's something we've calculated in Roman number 1, which we call what? Goodwill. There's something we calculated in Roman number 1, which we call what? Goodwill, which is one of the major computations in group accounts. When you master to do it, I told you in this case, you have become a pro. You have become what? A pro. Because in this case, what happens, it is that the goodwill, once you calculate it, it will appear as an non-current asset in the consolidated statement of financial position. Then you have another one, in this case, you have to calculate, we call it what? The non-controlling interest. What the parent company was not able to control in the net assets. This one, you normally put it under the equity items. When you are listing the equity items, you normally put it there. Then we have in this case what? The retained earnings. It has also in this case some calculations. So this one still basically will appear under what? The equity items. So there's a way in this case you are supposed to be able to calculate them. There's a way in this case you're supposed to do what? To calculate them. And therefore, we can actually be able to look at how in this case we do end up having to come up with the non-controlling interest. And maybe in this case what? The retained earnings. So in this case what? The retained earnings and the non-controlling what? Interest. The retained earnings and the non-controlling interest. The non-controlling interest. You can be able to say computation of what? The retained earnings. Computation of retained earnings. Computation of retained earnings. I think it is the adjustment number 8. And put a number because the one we did before we did that illustration was number 7. This one is number 8. So for the retained earnings, this is how you'll be able to come up with it. You'll take the parent retained earnings. You'll take the parent retained earnings. So you'll be able to take the parent retained earnings. The figure for the parent retained earnings. Remember, you have actually been given for the parent and the subsidiary. So you just go to the statement of financial position and pick the retained earnings for the parent company. Then this is how you actually end up having to adjust it. You add the parent share of post-acquisition. You add the parent share of post-acquisition retained earnings, post-acquisition what? Retained earnings, post-acquisition retained earnings in the subsidiary. In the subsidiary, you'll be able to add it there. Then you can be able to less, you'll actually less. When you do an illustration, you'll be able to see. But just know that is the format. Then in this case, you less unrealized profits. Unrealized profits. You less in this case what we call what? Unrealized profits on sale of goods. Unrealized profit in this case on what? On closing inventory, and less profit on closing inventory on an intercompany sale. On an intercompany sale. On an intercompany sale. If you look at in this case, when you're having to talk about URP, I was having to tell you that in this case you do what? I was having to tell you do what? You debit cost of sales or retained earnings. You are seeing me telling you this. If you go in this case to what we did like in number 1 adjustment, I was having to tell you debit the cost of sales or retained earnings. So that means when you're debiting the retained earnings, you are reducing that unrealized profits. Because you are dealing with profits, they were never realized, and therefore in this case you need to remove them. So if in this case consider that what? Unrealized profits. on closing inventory, when you're calculating what? The retained earnings to go to what? The statement of financial position. So you'll be able to eliminate it like that. Then in this case, you can actually be able to also consider, in this case, you have, in this case, maybe what? Depreciation. You can have a depreciation under charge. Depreciation under charge. You can have a depreciation under charge. You can be able to consider it here. You can be able to consider it here. So you can also be able to consider it here. Depreciation under charge. Under charge. It can be there. Remember here, we can also be able to have depreciation overcharge. Depreciation overcharge. So if there's an overcharge, you'll have to add it back to correct it. You'll have to add it back to be able to do what, to correct it. And of course, I'll be able to tell you at what particular point in time these items will come here. I will tell you, but you just know this like the format. I will tell you now in our subsequent class at what particular point in time these items will come to the retained earnings. There's some particular point in time they might not come here. There's some particular point in time they will come here. You'll have to consider them when you're calculating the retained earnings. Sometimes you won't consider them. Sometimes you consider them. It depends with, in this case, what? The selling company. Is it in this case the subsidiary, or is it in this case what the parent? There's what we call upstream and downstream. Downstream is where in this case the item is actually sold, but in this case what? The parent to the subsidiary. Upstream is where in this case the item is actually sold, or the goods are actually having to be sold by the subsidiary to the parent. So those upstream or downstream will determine whether, in this case, these retained earnings will be affected or not. But this just know is like in this case what? The standard format. With this, now you'll actually be able to get what? The group retained earnings. The group retained earnings. You'll be able to get the group retained earnings, which in this case you'll take to the consolidated statement of financial position under the equity part. So this is how you'll be able to get it. You take in this case what? The consolidated statement of financial position under what? The equity part. This is how you get what? The retained earnings. It is a key computation when you're having in this case to come up with the consolidated statement of financial position. So once this one you master it, then you know you are now becoming a pro in group. You are becoming a pro in group. Sometimes it's a bit complicated, and we normally advise students when you're doing exam, never start with it. Never start with it. Never start with it. Do it as like in this case the last one. Also the LCI, never start with it. It can eat your head. It will eat your head, yet in this case you want to collect marks very fast. Yet with all these kind of calculations, you get the same mark. With the other items, which in this case you're not having to do a lot of what calculations. So this one might confuse you, might end up having to confuse you. But in this case, when you be doing it, you need to be very keen how you're arriving at it. Just be very keen with how in this case you're having to arrive at what? The retained earnings to the CSFP. CSFP. The CSFP. Can the group retained earnings end up having to be negative? I've never seen that kind of a situation whereby in this case they likely end up having to be negative. They end up having to be negative. There's no way in this case they will end up. If they are negative in this case, you know maybe what could have happened. None of the subsidiaries has not actually been able to make a profit consistently, like for so many years. So that means it won't be there. You know, in this case, when we talk about retained earnings, they are simply profits a company has been making and they have actually been accumulating. They have been retaining them. They have not been paying dividends. They have been retaining them. So rarely it will be negative. In this case, if it is negative, it means it will already basically be eliminated in the comprehensive income statement because it would have made a loss. And therefore it can never be part of what? Part of equity. When you talk about retained earnings, you know what it means to retain. You have earnings, but you're retaining them. You're not paying them out. So it means previously the company has made a lot of profits, which is that it has been accumulating. So with this kind of accumulating, it means this figure that is here is very big. Is very big. So in this case, it can't be negative. It is negative, it is basically disappearing in the comprehensive income. It won't even end up having to appear under the equity item. It won't actually end up having to appear there. So it will basically already be eliminated in what? In the comprehensive income up there before it comes to the statement of financial position. So it will never be negative. It won't come across in this case a situation where it will end up having to be negative. If it is there, it means the company has been accumulating profits over the years. Then now they have accumulated. So in this case, for this year, we are just having to make what? A few adjustments there. a few adjustments there. So that's basically how you come up with what? The retained earnings. When you do an illustration now in this case, you will see how the figures align, how the figures end up having to align, how they end up having to align like that. So that's what in this case will likely end up having to happen there. Yeah, so I think we can end there. So let's not in this case continue with a lot of issues here. Let's not in this case continue with a lot of issues here. We can end there. So next time, in this case, on Thursday, I'll be able to show you NCI. I'll show you in this case how you come up with a non-controlling interest. Then I think we'll be able to do a comprehensive income that has what? A consolidated income statement plus a consolidated statement of financial position. So it'll have both of them. So that you see when you have both of them having to be called upon to prepare, how do you go about it? And it has all these adjustments, retained earnings, it has NCI, it has goodwill, everything is basically combined there in a single question. So how do you go about having to deal with it? So we'll be able to do that kind of what? An illustration. So I think we can end there for now. Let's end there for now. So we'll do NCI, then in this case after that, we'll be able to do what? An illustration. Be able to see how you can actually be able to do what? Work out. But of course, I can be able to give you maybe just a question, which in this case, of course, is like the one we'll be able to have a look at in our next class. You can just maybe be able to try and actually practice with it. Try to practice with it. Try to practice with it. Try to practice with it. And see how in this case you can actually be able to come up with it. All those. And be able to come up with all those. You can basically in this case try to look at this question. Look at September 2015, question 1. September 2015, question 1. Try to have a look at it and see whether in this case you have like a clue as to how you could have actually been able to do some of the adjustments. But that's the question you'll be able to look at. It basically comprehensively covers everything that in this case you've looked at as what? The adjustments. So to be captured in that particular question. The cash in transit, the intercompany balances, all of them are there. The goodwill, it is there. The NCI, it is there. The retained earnings, it is there. So that question will be able to give us a comprehensive understanding. So I think we can end there. So unless there's a question, let me end there. So just look at this one as the assignment and see whether you can be able to do something about it. Look at this one as the assignment and see whether you can be able to do something about it. September 2015, question number 1. So that's it. So we can end there for now. So let's meet on Thursday. Let's meet on Thursday. Let's meet on Thursday and see how far we'll be able to go with the group accounts. Otherwise, thank you so much and have a good night.